For some people, risk management is all about the risk per trade. You put a small risk per trade, your risk management is good. Or you put a high risk per trade, your risk management is bad. But there's a lot more to it that really isn't talked about much on YouTube. So I thought it'd be good to bring out a full-time scalper on our team to show you exactly what risk management is like, what he's using for risk management, what his exact rules are, so you can use them for your own trading. And you'll see that there's a lot more to risk management than just risk per trade, and it goes way beyond that. I hope you like it. If you like this video today, make sure you give it a like also. And we'll dive right into it with these risk management rules from a pro scalper.
All right, traders. 3 things I wanted to talk about. Risk per trade, risk management in general, and the law of large numbers within this 2-hour, 3-pip scalping framework. As you know, I'm a full-time scalper, and the 2-hour, 3-pip scalping window represents one component of my overall trading business. It is designed specifically for consistency, repeatability, capital efficiency, rather than large individual wins. Right. So the first topic I really wanted to talk about in regards to all of this is risk per trade. So within the framework itself, risk per trade is intentionally kept very small. Individual positions are typically entered in the order of 0.25% increments, allowing exposure to be built up gradually and only when the conditions remain aligned with the original plan. Total exposure for this strategy is strictly capped at 4%, which acts as a hard boundary for the entire session. Because the profit target is reduced to 3 pips, the strategy is designed to achieve a very high probability of success. Risk is therefore not managed on a per trade outcome basis, but rather on aggregate exposure, position scaling, and strict session limit. This ensures that no single trade or sequence of trades can materially impact the account. Point number 2 that I wanted to talk about is risk management overall in this approach operates on 3 levels. Right? The first level is session risk. The strategy is confined to a defined 2-hour trading window with predetermined maximum risks. Once that window or that risk threshold is reached, trading stops, regardless of market conditions. The second layer of control is structural risk control. And for that, we use market-derived standard deviations to segment price into defined trading ranges. I call those boxes. These boxes provide objective boundaries for trade location, helping avoid emotional decision-making and over-trading. Trades are structured to favor mean reversion with an expectation of more bounces than breakouts during our 2-hour sessions. And the last layer is active risk mitigation, right? Given the intentionally asymmetric risk to reward profile, break-even management is used aggressively. When markets conditions weaken, positions are actively managed toward minimal loss or flat exits, preventing small losses from compounding into meaningful drawdown. And the last point that I wanted to talk about today is the law of large numbers with this particular strategy. This strategy is explicitly built around the law of large numbers. By lowering the profit target to only 3 pips, the trading within a well-defined structural and temporal constraints offers an edge. The edge does not rely on any single trade. Instead, performance emerges from the repetition of a statistically favorable process applied consistently across a very large sample size. So over time, dozens of small, high probability trades per per session, repeated day after day, allow the expected value of the system to assert itself. Individual outcomes are intentionally de-emphasized in favor of process fidelity, consistency, and long-term expectancy, measured over years, not days. Okay, so portfolio context. This 2-hour business, 3-pip scalping model is not a standalone strategy. Outside of this window, I also manage in higher time frame, multiple trades across multiple assets, multiple time frames, all with a positive risk to reward profile, which serves to balance the overall portfolio and offset the structural limitations of short-term scalping with an inverted risk to reward ratio. Additionally, capital is distributed across multiple accounts to reduce broker-specific risk and operational dependencies. And we approach that aspect with trade copiers. And so, to summarize, the approach itself treats scalping as a business process, not a prediction exercise. Risk is controlled through small position sizing, strict session limits, structural market framing, disciplined execution. Profitability is achieved not through outsized wins, but through consistent application of a repeatable edge across a large number of trades over time. I hope this was useful.
All right, so I hope you got some value out of this. It's been cool to see Jean-Francois Boucher talk about this stuff. We don't really see much good stuff about risk management on YouTube, so I hope this has been of value. Make sure you comment below with your favorite advice in this video. Make sure you like the video if you liked it. And if you want to see more about Jean-Francois Boucher or more about scalping, check out this playlist here on the screen. It's a packed playlist with full of scalping tips, scalping lessons, all this good stuff. And hopefully you can get some good value out of it. With that being said, I'll catch you back here in the next video pretty soon. Ciao.